So I heard you want to invest but you don't know how? You've come to the right place. In this video, I will be explaining all the ins and outs of investing in the stock market. Here are the areas we'll be focusing on. Investing versus trading, fundamental analysis versus technical analysis, individual stock versus index fund versus ETF, and how to choose, how to set it all up, and what to expect in terms of returns. If this sounds like your cup of tea, let's get started. First of all, let's make it clear. When we talk about investing, we usually refer to long-term stock market investing instead of short-term or even intraday trading, which is the frequent buying and selling of stocks within a day. As a stock market investor, I focus on investing, mainly long-term investing, which refers to buying and holding onto a stock for more than a year. There are, of course, exceptions to the rule. For example, if there are major changes to the company, so much so that I decided it is no longer a good stock for me to hold, then of course I'll sell. This is not like a permanent tattooed rule, but for the most part, I like to only buy companies that I feel like will be a good investment for at least a year. This is for three main benefits. So first of all, of course, it is less work. It is less work to buy and hold than to frequently buy and sell, because every single time you make a purchasing decision or a selling decision, it has to be backed by evidence and it has to be backed by research. And of course, the more you buy and sell, the more research and work you have to do. So number one is it's less work. And number two is that you get to pay less taxes, because every single time you buy and sell within a year, you have to pay short-term capital gains tax, which is taxed at a higher rate than the long-term capital gains tax. And number three is more gains. Research has shown that the more you buy and sell, actually for most people, the less money you earn. It is opposite of what we learned from school, which is the harder you work, the more you gain. In the stock market is the exact opposite. The more you buy and sell, usually the less money you gain, and actually you tend to lose money. It is often said that the success rate for day traders is around 10%, which means 9% of day traders lose money. Corey Michael at Vantage Point Trading is even more pessimistic and said that only around 1% of day traders actually make money. So now that we learned about the difference between investing and trading, let's also talk about technical analysis versus fundamental analysis. So in my opinion, one of them is totally logical and reasonable, another is not. Guess which is which? Yes, technical analysis, in my opinion, is the less logical and intuitive one. Fundamental analysis, in my opinion, is logical one because it actually looks at the fundamentals of the company, aka it involves reading the financial statement, understanding how the company operates, and doing proper company analysis. Whereas technical analysis is usually looking at stock charts and looking at patterns and predicting human behavior, which, it's not always predictable, especially when there are so many variables. You're not just looking at one person's behavior, you're looking at the entire market, and you're also not just looking at retail investors, you're also looking at institutional investors. In my opinion, technical analysis is just not very accurate, and it's also, of course, a lot of work, a steep learning curve. So that's why I recommend looking at fundamental analysis instead of technical analysis. So now that you learned about the difference between technical versus fundamental analysis and which one I prefer, let's now talk about individual stocks versus index funds versus ETFs. So contrary to common belief, you don't have to stock pick in order to invest in the stock market. I think a lot of people, when they think about stock market investing, they immediately jump into stock picking mode, which is actually only one of the many ways to invest in the stock market. There are plenty of index funds and ETFs you can invest in, which simply put, it's just a basket of different stocks that you can invest in all at once, so you don't have to, handpick individual stocks. So index funds and ETFs are pretty similar. Think of them as different baskets. The main difference is really in how they work. So ETFs, they tend to be traded more easily than index funds. ETFs, the full name is Exchange Trade Fund, and they have a stock-like nature, which means they can be bought and sold throughout the day, just like a stock. You don't have to wait till market close in order for your purchases or your sales to settle. Whereas index funds can only be bought and sold at market close, so at a specific time and also at a specific price point. In both cases, you'll have a basket of different stocks, so you don't have to do the heavy lifting, aka stock picking. In my opinion, it doesn't really make that much of a difference between index funds and ETFs, as long as you keep one thing in mind, which is the expense ratio. When you have a really high expense ratio, that can cut into your profits, so you definitely want to get that checked out. And of course, always do research on exactly what you're investing in. Even if you're investing in a certain index fund or ETF, you have to know what's inside. You have to know what index is it tracking. And now let's talk about how to set it up. It is actually really simple. Just two main things that you need to do. The first thing you need to do is open up a brokerage account, and the second thing you need to do is to actually invest the money within your account. So here I recommend two platforms. One is Public, another is M1 Finance. So I am going to pull a screen recording of Public, and Public is one of the apps that I have that you can also get free stocks from as long as you use my link. So over here you can see I already have 20 bucks in it. This is all from free stocks, which you can also get if you use my link. And you can see there are different tabs. You can deposit your money, and after you deposit your money, it's not the end of the story because you also have to invest your money in different stocks. So over here you can see a couple different cryptos and also stocks. You can also search, for example, if I want AAPL, which is for Apple, then you can buy Apple, and it's super easy. You just click buy and you choose what amount. So it's super intuitive, and the great thing about Public is that it also has a community aspect, so you get to see what other people are talking about the different stocks, the different, let's say cryptocurrencies. It's almost like a Twitter space within your brokerage. So that is Public, and let's also take a look at M1 Finance. So within M1, let me log in. I don't know why it doesn't log in. It's almost like too secure. That's why it always logs me out automatically. So this is my M1 Finance portfolio. Over here, you can see that I have around $53,000 even after the recent crash. And you can see I am up by 36%, which is pretty good, especially in light of the recent market crash. And what is great about M1 Finance is that it's super passive, and all you have to do is to create a pie. So this is what my pie looks like. You can see I'm pretty heavily invested in tech and real estate, and there's also finance, healthcare, bonds, consumer, and telecom. And you can then select the specific stocks within your pies. For example, within tech, I have Tesla, Amazon, Apple, Microsoft, and Alphabet. So all of these stocks, you can preset the allocations. For example, you want, let's say within tech, you want 45% in Tesla, then 45% of your money within the tech slice will be invested in Tesla. And this way you don't have to track specifically what stock price. You just need to figure out what stocks you want to invest in and the allocation, and your money will be automatically allocated to these investments. And of course, if you use my link, you also get $10 for free. So now that we talked about exactly how to even invest, let's talk about what kind of returns to expect, which I think a lot of people, they are overly optimistic. I see too many people get into stock market investing thinking that they can become rich overnight. And of course, all of us want to make money. Why would we invest our money if we don't expect to make money? However, stock market investing is a long-term play. It is also not the place that will make you six figures overnight, unless you have a $1.4 million portfolio and the market happens to do super well and you pick the right investments. In order to make passive income, you need these four things. You need either a lot of capital or the right connections, network, or you have a really valuable skill, or you have compounding or time. So these four things are what is needed to make passive income. And I see a lot of people, they just expect passive income to be something that they just close their eyes and sleep and passive income comes, which it's usually not the case. And with stock market investing, you mainly need either a lot of capital or a long time. Because we're talking about early retirement here, let's assume we don't have a lot of time, and let's just put the focus on the amount of capital that we have, aka having a small portfolio versus a large portfolio. So let's say we're in a good year, we have a 7% on average return, not yet accounting for inflation. With a 500K portfolio, we can expect to make around $35,000, which is, pretty decent in terms of passive income. Whereas if you have a $500 portfolio, that is a $35 gain, even with the same 7% return. So you can see that a large portfolio versus a small portfolio, it's day and night. It makes a huge difference how much starting capital you have. And you can think about, what can $35 get you? Let me know in the comments. So all these people preaching, tax-free millionaire. Invest $200 for 40 years and then you can retire as a millionaire. Like, it sounds really good, but you also have to remember that it is for 40 years, right? If you want to have, a smaller starting initial capital, then you need a lot of time, but that is also not necessarily early retirement. But if you're looking for faster returns without at least 500K in your portfolio, then better look into investing in your skill, upgrading your skill so that you can upgrade your earning potential as well. And it doesn't necessarily have to be a course, right? You can Google things. It's just a trade-off between time versus money. Spend more time, spend less money. Spend less time, spend more money. If you value your time over your money, then of course you can use your money to buy back some time. If you value your money more than you value your time, then of course you can spend more time to figure things out on your own instead of hiring a mentor or buying a course to learn the necessary skill. It's honestly up to you. Which one do you choose? And here is what I believe. I believe money is replenishable, time is not. The time that passes, it will never come back. Whereas the money that you spend, you can always earn back as long as you still have the earning potential, as long as you still have the skill that helps you earn money. And here's a confession. I used to value money a lot more than I value time. That's why it took me so long to invest in myself, invest in my knowledge, hire mentors, and buy courses. It took me a really long time being in the YouTube community to actually, buy courses that teach me about YouTube. And it also took me a while in stock market investing. It took me a while to finally hire a mentor and also, invest in books and actually learn things systematically instead of just figuring things out and throwing spaghetti at the wall and basically wasting my time and money by experimenting with everything on my own. Now I value time more than I value money. I'd rather pay for the fast track instead of doing all the dirty work and experimenting all the things and making all the mistakes and, living with all these regrets. If I'm able to get on the fast track and avoid some of the pitfalls and mistakes, today, me today, I would do that instead of sifting through endless amounts of information that only leads to shiny object syndrome and decision fatigue. So far in the video, we have looked at investing versus trading, fundamental analysis versus technical analysis, individual stock versus index fund versus ETF, how to choose, how to set it all up, and what returns to expect from the stock market. If you haven't already, get a copy of my free roadmap so you can learn the 4 steps that I took to reach FIRE at the age of 25. I'm going to link my next video up here, but don't click on it yet. Make sure to subscribe if you want to retire early, and if you're ready to dive a lot deeper with me, DM me the word FI/RE on Instagram at cherrytongue.co.